In this week's update, is the worst behind us? Is this the bottom? And it just has to be quality G.A.R.P. My name is Garry Davis and I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. What a week. What just happened? You could be excused for asking. Did we ever in our wildest dreams think that trade policy out of the US and economic policy would be conducted basically off the cuff via social media? It's really quite an extraordinary period. And I'm sure when we look back in 10 years' time, once this presidency is finished, we'll just scratch our head and wonder if we actually saw what went on. It's quite amazing. And the other question, of course, is did we just see the biggest insider trading scandal in history, with President Trump tweeting a few hours before the pause in tariff announcement came that this was a great time to buy? So it's just mind-boggling what has happened, and it's no wonder that global financial markets, not just equities, but bonds, currencies, commodities, the whole bit, have had a week of extreme volatility. And in fact, volatility has got to a level that it really shouldn't do. It shouldn't get to the level that it had, but uncertainty was just so extreme. So what we've seen is, again, something that, our wildest dreams we probably didn't think we'd see, and that was Trump brought to heel by the bond market. And so there's the realisation now that he is not the biggest force on the planet, despite what he might think. So a real lesson there that at the end of the day, markets win. Market power controls what happens. And if things get too far out of line, then markets will yank them back into line, albeit very painfully for some people. But the issue we've got at the moment is that we're just one tweet away from who knows what. And that's the issue. We can't take what looks to be logically likely and extrapolate that into the future, because we have no idea what the future might look like. So it's certainly a very challenging investing environment. Is this the low? Look, I think the odds have swung in that direction because of Trump's policy shift. That when you look at all the indicators that I look at, I think you've got to conclude that we're more likely to get a low from what happened in the last week than where we stood a week ago. So I think the odds have swung in that direction, which means that we can start to modify our exposure to the market. But we need to do it in a very, very controlled way, because this could be quite temporary. So we're not in clear sailing yet by any stretch of the imagination. So what happened last week? Well, bond yields started rising very sharply in recognition of where the bond market believed that matters were heading. And the conclusion of the bond market was they didn't like it one little bit, that it was, in fact, it really had the sort of feel, the sort of Lehman Brothers 2008 feel to it, just the sentiment and the rhetoric. And when you looked at what happened to the VIX and what happened in the bond market, it really was rapidly approaching that sort of totally out of control situation. We'll never know how close we were to the edge, but I suspect it all unfolded so quickly that I suspect that we were a lot closer to the edge than what a lot of people are acknowledging or thinking. The bond market is saying that the market is heading for higher inflation, or the economy, the US economy, is heading for higher inflation. There was also almost certainly a level of retaliation from countries that the US is going to impose tariffs on. And, you've got to expect that. You can't treat former allies the way that you do, meter out levels of criticism and ridicule and not expect some sort of pushback. So I think there's almost certainly an element of retaliation with other countries selling US debt. And then we got into a spiral, as markets often do, because these days markets are so leveraged, that we got into a spiral of forced selling. So it wasn't selling by choice, because The owners of those assets thought that they needed to be sold. A lot of this was forced selling that arose from margin calls and just the general reversal of momentum trades in so many areas, not just equities, but in bonds and currencies. There's just so many highly levered trades across all asset classes that it triggered a lot of those sort of reversals. The result was massive volatility that was so extreme that it's almost technically not possible. That's how extreme the volatility got at varying stages in the last week. And this was largely the unwinding of very highly leveraged hedge fund trades. So what do we do about all this? Well, let's first of all look at what not to do would be the first thing. And I'm sure there's plenty of people out there that succumbed to their psychology and succumbed to their fears. But what not to do is to sell into this kind of completely disrupted market, because normal price discovery is just out the window. So you're selling into a market where the current prices could mean absolutely nothing and therefore change back again very, very quickly, which is in fact what we saw. So if you're selling into this kind of panicked, extreme market, you're almost certain to make your portfolio far worse. You might feel better that you've now reduced the pain, you've reduced the exposure, but when you look back a week or a month later, I think you'll discover that you've probably made the worst decision. And the rebound that we saw on Thursday in Australia was so extreme that anyone who sold in the few days prior to that, just at this point in time, just has to be worse off. And I've spoken about this a couple of times in recent weeks. Many studies show, that you typically miss the best days in history because the best days in history follow immediately after the worst days in history. So if you're selling into this kind of environment, then you're going to miss out big time. And the impact on your portfolio is huge. And again, I've been pointing to that over recent weeks. And I also made the most important point, and that is that adjustments should have been made weeks ago. If you watch this video, you should have been in no doubt 6 weeks ago that you needed to start making some adjustments because all the evidence was there. Hoping that the problem wouldn't unfold is not the way to go. You've got to make the adjustments. You've got to recognise it for what it is, make the adjustments quickly, and then you're in a much better position. You're not forced then to sell by your psychology when we get a week like we had last week. So a far better approach is just to target the best of the best businesses that will grow under almost all scenarios. Forget diversification. Diversification is a strategy for those who don't really know how to manage risk on a targeted basis. Sure, you can get some diversification within targeting just the best of the best because there's always a level of uncertainty in the market. But if it's just broad brush, traditional diversification, you're just so exposed to the market fluctuations, it's not the best way to go. So just get laser focused on the stocks that have got the highest probability of growing strongly under most circumstances, and that is an enormously profitable starting point. You then need to couple that with a simple entry and exit approach, and I talk about this every week for years and years and years. I'm just trying to find different ways to express the same message because most people need to hear a message sliced and diced multiple different ways until it really rings true and hits home. And then, again, probably the most important thing, because without this one, the first couple don't really work too well because we wander away from the straight and narrow track. You need to get ongoing refreshment of your perspective on what markets are doing. Otherwise, it's just too easy to get drawn offline by what the media has to say, by what your logical brain is telling you, rather than being in an environment where you can constantly be reminded of a correct perspective, of a realistic perspective on markets are doing. Being able to acknowledge what it is that we can see. It's right in front of us, but often what's going around in our head doesn't allow us to see it. So I hope all that makes sense. And I know that dealing with our psychology is not the first place that investors want to go. It's just too hard for some people. It's uncomfortable, but it's so important. Now let's look at what quality growth at a reasonable price is. So let's unpack that a little bit so that everyone understands what I'm talking about here. So targeting quality growth stocks. So first of all, quality, and that has a number of aspects to it that I've touched on over the years. It relates to the quality of management. It relates to the progression in the financial metrics, the smoothness of the financial metrics. It relates to a lot of those sort of fundamental indicators. And if you are targeting, first of all, growth, because if you've got a stock that can continue to grow its earnings, if they find themselves in a bit of a sticky situation like many companies are at the moment, then they can grow themselves out of it. It just takes a bit more time than in a normal environment. But that growth allows them to grow into the new environment. And if it's a real quality growth stock, then it gives you a greater margin for error. More things can go wrong without really impacting the business that much. So quality growth is far better than, let's say, defensives or staple stocks that always get trotted out at this time. And there's a lot of financial advisors out there that will try to point you towards so-called defensive stocks. But these are low growth stocks. Now, I know that they're probably less volatile, but if you want to look out over the next couple of years, which stocks are you going to do better out of? A defensive low growth stock or a quality growth stock? And I can tell you the answer is extremely obvious. So they significantly raise your odds of success. And that's all we've got in the market. We don't have certainties. We only have probabilities. And you want to do things and be in stocks that raise your probability of success very significantly. And where is the best place to find this? And again, I've mentioned it a couple of times in recent weeks. One of the best places, one of the highest probability places that I know are businesses that have been built by a founder who's still active in the business and who still owns a substantial share of that business, because all the decisions to do with allocation of capital and all the rest of it is made in the best interest of all shareholders because they're the major one. So you can always be assured that decisions are not being made to manipulate the short-term share price or whatever it might be, raising capital at a level that actually destroys shareholder value rather than increases shareholder value. So that's one of the best places to look. And a very significant chunk of the Insiders Club portfolios are in just those kind of stocks. Now let's unpack the second part, and that's a reasonable price. If you pay too much, then it might take quite some time, perhaps years, for the business to grow into the current stock price. And so that stock price might go sideways, or it probably will go down, particularly in an environment like this. And we're seeing that at the moment. Some of the really high PE multiple stocks, fantastic businesses, but they're just too high a PE multiple for this kind of market environment. People are no longer prepared to reward the company with that sort of PE multiple, and they've come off quite significantly, 30, 40, even 50%. So if you can get a reasonable price, a valuation that makes more sense for this kind of environment, then those lower entries de-risk and also amplify your returns. So think about it. The lower you buy, if you've got a great growth asset that's going to grow in price to a certain level in the future, let's say in 3 to 5 years' time, then the lower you buy that, then the greater the upside return you're going to get. It's pretty obvious, but some people miss that very obvious fact. So lower entries are really critical. And what we've just seen in the last couple of weeks with this dramatic sell-off has provided just an extraordinary buying opportunity for these sort of assets that I'm talking about. Not for the whole market, but for the assets that I'm talking about, the founder-led businesses and the like. It doesn't have to be a founder-led business, but you've improved your odds dramatically, and studies show that. So getting a lower entry de-risks and amplifies the return. And isn't that what we're all after? And when is the best time to achieve that? Well, it's right now. Now, I'm not saying that you push all your chips into the middle of the table, not by any stretch of the imagination. I practice and have for years progressive accumulation of quality assets. Just bit by bit, steadily, don't take big risks. Managing risks should be the first priority, and making a profit should be your second priority. If you manage risk well and you target good assets, then the profits will just be there. So now in general, is a fabulous time because quality assets are on sale. They're far, far cheaper than they normally are. And if you go back and look at last week's video where I showed the big picture of markets going back to 1987, and the fact that indices and, of course, then by definition, individual stocks over the years just go on and set dramatically new highs. And the situation we find ourselves in at the moment is not good. It's pretty serious. However, is it as serious as 2008 in GFC? Is it as serious as the COVID years? In my view, it's not. So I think this will prove to be, in general, over the next period, of just a fantastic time, fantastic opportunity. But because we can be less sure about what US policy will be than has ever been the case before in history, we just need to go a bit more slowly, a bit more gradually. But we can help ourselves a great deal by being very targeted. So this is a period when others don't want to buy. So that means, again, we're getting opportunities that we don't normally get. And right at the moment, I think the lowest risk is starting with the most compelling chart patterns, because then what you are following is the money flows of the market. And at the end of the day, we make money because we buy low and we sell high. It's no more complicated than that. So observing and reading chart patterns in terms of what is it telling us about money flows and the most compelling charts is the most reliable way I know to make short, medium and long-term profits. All right, so our response now, going back to the theme of how do we manage risk primarily? So how can we get a large edge which is big enough for an environment that is probably as uncertain as we've seen? Maybe not quite so much, because COVID, we just didn't know how that was going to play out. So I think the uncertainty around that was horrendous. The GFC, I think the world got pretty close to a financial meltdown. So that was all pretty uncertain. But this is certainly up there. This is a environment that we haven't struck before. And a lot of the norms that we see, the things that would normally happen, the central banks do this and governments do that to rectify the situation, it's all probably a degree more or less reliable. So the message that I've been preaching now for some time is we only want to fish in the highest probability ponds. It's a very small pond in terms of the percentage of the market, and it's a very specific pond because I'm looking for very specific things in a business. And it's all about finding the highest probability growth that I can. And if I don't see things that I think are high probability growth, then I just move on until I find ones that are. But I can tell you in the Australian market, there are plenty of stocks that have the characteristics that I'm looking for. More than enough to fill anyone's portfolio. You've just got to be selective on the stocks and then selective on the entry prices. So the number one skill for me, fundamentals are important, but my approach has always been fundamental analysis is there to put us in the right ballpark. It's not to give us a precise answer, because the market can and does do something different to what the precise answer would indicate. So why bother? Why bother to go to the nth degree to value a stock? To me, it's pointless because the market can just do something completely different. So reading money flows and the commitment of buyers to come in, particularly at points like we're at the moment, is the number one skill. And then just observing an orderly process. Don't let your emotions get the better of you in a week like we've just had, because it'll make your portfolio performance far worse. And I thought I would repeat what I did last week, because I actually got a number of emails and comments from various investors about making life easier for yourself. And that was, don't look at your portfolio bottom line, just track the chart patterns. So don't look at the total of up or down so much. Look at the charts, look at the prices, but don't look at the end result. And I was pleased and rather surprised at the number of people that contacted me and said they started doing that, and how instantly better they felt, how instantly more relaxed they felt about the markets. And it obviously made sufficient difference that they took the trouble to write to me. And I also said we want to add to target stocks as the charts indicate, because the buy and the sell balance is shifting. Now, it might shift back again. We can't control that. But I'm confident in saying that that balance is shifting for the minute, and we should acknowledge that and start to shift with it, but probably gradually. Right, I've covered a lot already, and it all distills down to the same thing. This is general advice. You need to obtain your own advice, but just recognise how important obtaining your own advice is, because particularly in this kind of markets, it is so much easier to lose money than make money. So you need to do a lot of simple things right in this kind of market. Right, let's look at the US market. The S&P was up 5.7% for the week. That's big, but it was following a pretty big down week, and that's even with the disruption at the start of the week. And the NASDAQ by 7.4%, so that's how incredibly large the rebound was. IWM, only 1.7%, so that's disappointing. The equal weight S&P was up just over 3%. I'll show the chart of NVIDIA because I think it sends a bit of a message there. NVIDIA is getting a bit of a reprieve, and in terms of their ability to sell chips where they want to, and that fed into the semiconductor sector. And that's always really good for tech sentiment, and really very good for the sentiment of the market as a whole. Now, the US dollar, hugely volatile. We're now down under 100, so that's dropped a good 10, 12% in a reasonably modest period of time, so that's huge. And what we're seeing at the moment, and that's why we might continue to get some follow-through, is that the reputation of the world's most important price-setting assets, so the assets that just about everything else gets priced off, is being trashed. The reputation and the reliability is being trashed by what's going on at the moment, and that's not good. The 10-year yield is up to 4.5, and it's pretty obvious that there's a level of de-dollarization. In other words, other countries are seeking to reduce their exposure to US dollar assets because the confidence in those US assets is declining. So I'm not sugarcoating this. This is a potentially serious environment, but hopefully cooler heads have prevailed, and we've seen a policy shift in the last week, or the bond market has forced a policy shift. Now, the VIX index has eased a little bit, but it was still very high. We're still at not far off 40. And if we go to the chart, actually, I will go there first. So that's the VIX index going back to the very early 2000s. So you can see we had massive peaks for those that didn't catch this last week. And if you didn't, then looking at last week's video where I went back and looked at the VIX peaks and what actually happened to assets during that period. So we had a massive spike to over 80 in the GFC. We've had a couple of spikes above 40, 2010, 2011. Then we had the COVID spike, of course, that was very large. But you can see where we're at the moment is it's up in pretty rare air. We don't get up to this level very often. And if we zero in and just look at the last, let's say the last month, then you can see we've been holding up above 30 and up as high as 50 now since the start of the month. So nearly 2 weeks at this very elevated level. So not only is this sort of level rarely reached, but it also doesn't tend to hang up here very long. So the market's still very much on edge. Let's go and look at some charts. This is the NASDAQ on a weekly chart. A huge dip the week before and then a big recovery, but not before we had this amazing price action. So that first day was the Monday. So a very positive day on the Monday. We then had follow through and then a huge sell-off again on the Tuesday. Wednesday doesn't need any explanation. Everyone knows what that's about. We then had a rethink on Thursday where the market gapped down. And that's not unusual because Wednesday was probably significantly overdone with short covering as one factor. And then we managed to finish well on Friday. But look, positive, negative, positive, negative, positive. It's impossible to be getting in and out of the market when that sort of activity is going on. Let's just look at the S&P. So the S&P mirrors that almost exactly as it should. There's the RSP, the equal weight, and the Russell also not as extreme in the moves. Now, let's look at a couple of key spreads that I've been looking at in the last month or so. And this is the S&P index versus gold. And despite the fact that we had a recovery in US indices, gold performed even better still. And so this ratio between the S&P and gold continues to fall and continues to fall very sharply. And this is all wrapped up in the whole de-dollarization, unwinding of margin calls, all that sort of thing. It's all related. And the other chart that's important is consumer discretionary versus consumer staples. And you can see this shows that with a falling ratio, that means that money flows are tending to move out of the consumer discretionary sector and into the more defensive consumer staples sector. Just a couple of other charts I want to highlight very quickly. This is Amazon and showing exactly what we saw in the NASDAQ, and that's green, red, green, red, green. Impossible to trade that sort of thing. This is Google. I covered that last week when I was looking at valuations. So again, if you want more color around that, go and look at last week's video. And the final thing I want to show, or second final thing, with NVIDIA, despite all the grossly overvalued rhetoric, which has really been going on now for probably a year, the commentary has been how overvalued NVIDIA is. But let's just step back and not just blindly accept all the nodding heads and market consensus and look at the actual valuation. So 2026, the market is definitely starting to price in 2026 in the NVIDIA stock because it's working 6, 9, 12 months ahead. So if we look at the earnings into 2026, they're expected to grow 51% to $4.53, and the current PE ratio is 25. There's nothing wrong with that. But it's 25 because the market is thinking and saying, well, we don't believe that these earnings are going to be sustained. And that's probably fair at this stage. But there's still quite a bit of margin for error there. 2027, the market is forecasting another 26% rise in earnings to $5.72. And bear in mind, market consensus on such a big stock like this, there's not that much of a lag, really. It's covered by so many analysts. And they've had many, many weeks now to make these adjustments to forecast earnings per share. So I don't know that this is going to be dramatically wrong. And that puts us, with a 26 year-on-year growth, puts us on a PE multiple of 19. And in 2028, we're expecting to see another 15% growth. And again, this is all normal because the further out you go, analysts are less likely, or they're more likely to be conservative, if you like. But that still has NVIDIA on a PE of under 20 a couple of years out. So I just think all this narrative and rhetoric around NVIDIA valuations is all past tense. And when you look at the price chart, here's the all-time highs. we're not that far off the all-time highs. I would have expected, given all the rhetoric, that NVIDIA would be trading far, far lower. So the market is telling us something very different to what the rhetoric is. And the final chart I want to have a peek at, this is one that I showed last week. And I was just making the point that the market moves were so extreme that it means that these unwinds are probably fairly short term. And if you look at Microsoft chart, then we can see that very, very readily. All right, back to the presentation. So that's the US market. Looking at Aussie stocks, our dollar rebounded very strongly because the US dollar plunged. Last week I said 20-year lows are now in play, and there's no reason to change that. We just had a 1 or 2 day blip based on US dollar weakness. Now, I don't know where the US dollar is going from here because there's too many uncertainties. It would be very, very difficult to try and predict that. But certainly the Australian dollar is under pressure in general terms. Our index ended up down 0.3% for the week, but it would be reasonable to assume that we'll get a continuation of the bounce on Monday. Reading higher probability reversals is really vital in the early stages of a recovery because we know that certain stocks recover early and quickly, and other stocks take a long time and may not start to rebound until even the index lows are in. So you want to be starting with the stocks that are most likely to rebound strongly and early. And therefore, the only way you can do that, you can't do that by fundamental analysis. You can only do that by observing and responding to what the market is showing you. And it just improves your odds of success. Let's go and look at the Australian market. Well, actually, I'll just check on the currencies first. So there's the US dollar index. As you can see, 2 huge down days on Thursday and Friday. And the Australian dollar responded obviously in the opposite direction, but still not to the same degree that the US dollar has been sold off. So there are still other forces weighing on the Australian dollar. And of course, one of those is what happens in China. Then with the 145% tariffs on China, it's very unclear how their economy is going to progress and what the central bank response is going to be. So that's the currencies, but the lower levels are definitely in play. Now, if we look at the ASX 200, you can see over the week we were down very slightly, but a huge amount of volatility if we put that on a daily chart. So you can see an enormous rebound Thursday, but closed well off its lows. And I think this is perhaps the story to remember about the Australian market, is that it had an incredible lead from the US, and yet there was still lacking the buying commitment to drive that strength all the way into the close, as the American market did. So that lengthy bit of selling there towards the end of the day, that sends a signal to me that the Australian market buyers are not as committed as they were in the US. If we look at other sectors, we're seeing similar kind of pattern on materials, and this is a weekly chart, and materials is in downtrend. All of our short, medium, and long-term moving averages have rolled over, and the price is below all of them. You don't need to get very complicated about technical analysis. That's really all you need to know at this point in time. Now let's break it down a little bit into the sectors. This is energy on a weekly chart. Had a very poor week, obviously, with crude oil, and I'll come to that in a minute. But with crude oil down almost to $60 now, that impacted the energy sector a great deal. Finance similarly sold off and then recovered, but not to the highs of the week. So there's definitely some selling lurking around there. And this was a key level here, which we broke very, very quickly. We've rallied back to it, and then we've dropped away again. So whether we stay above or just below this dotted line here, which is around about 8,500 points, is pretty important for the finance sector. Healthcare finished the week pretty poorly. And this is information technology. Obviously finished the week much better, but still managed to attract some selling. Moving now to precious metals. Gold was up $200, thank you very much, to 3,240. A very, very strong week. Translate that into Australian dollars, getting up towards 5,200 Australian dollars. And silver also rebounded. It was only last week that silver was trading down in the low 30s, below $31. And then it rebounded very sharply to 33, 32. And finally, we're seeing over recent weeks, we're seeing gold miners, which had lagged for a long time in Australia, finally really starting to smash it. So that's very encouraging. And I've got some more important perspective to show on the global scene as well. So as far as gold and gold stocks go, this is the big rotation that I've been waiting for, that we've been waiting for. And I've commented many times during 2024 how relatively disappointing gold was. I thought gold was entitled to do better. And there again is a strong message that if you're relying on fundamentals, what is logical, what should happen, then quite often you come up with the wrong answer. Much better to start with watching what money flows are actually doing and going from there. Now, last week, these are the price drivers that I presented this to try and give viewers confidence that this is more likely to be sustainable than not. Now, again, nothing is ever guaranteed, but this is more likely to be sustainable because of these price drivers, and there are so many of them. Concerns around US stagflation and global growth, diversification from the US asset control, weaker US dollar, which we saw in spades in the last couple of days, the geopolitical uncertainty, of which there's probably never been more, the fears in the bond market about some sort of meltdown, and just the uncertainty of US policy. What's it going to be tomorrow or next week or next month? It's that level of uncertainty that is really driving the move into gold, but it's certainly not the only factor. There are many factors involved in that. So let's go and look at the gold charts. We'll start, first of all, with silver. So silver on a daily basis, so you can see 4 of the 5 sessions last week were very positive after having hit a low of 28.43 and then closed very strongly. And again, a couple of things here are really important. The length of the candle is important because that says commitment. And the fact that it closed almost on its highs, the last 3 sessions, also says commitment. That means the money flows are strong and they're committed and therefore more likely to keep following through. Not a guarantee, but more likely to keep following through. In US dollar terms, again, this is a daily chart. You can see the last 3 days since all the turmoil in the bond market and the about-face on tariff policy have just rocketed off. So we had a 3-day pullback, which was normal because we're getting a little overheated here. But the fact that it was able to turn around and go back up again after only 3 days and close in the fashion that it did, long candles closing on their highs, this is enormously positive and therefore makes it more likely about what happens in the future. This is the Australian dollar. Finished, in fact, at one stage did get over 5,200, got to 5,250. So that's extraordinary. And Bitcoin managed to recover a little bit. So risk on became a little bit more of a theme and closed at 83,000. Now, importantly, I just want to go and show some of the stock indices. So this is the Aussie GDX version. An enormously strong week last week, as you can see. We had a brief sell-off, bit of brief profit taking at the start of the week, but then all turned around dramatically. And look at the volumes that we've seen over the last 6 to 8 weeks. Volumes have definitely picked up and are more concentrated, more sustained. There is more money flow definitely going into this index. So that's the Aussie index. So it's well and truly on its way. But interestingly, when we look at GDXJ, which is a global index covering the so-called juniors, but there's an awful lot of very substantial gold miners within this index. What struck me, and I've been talking about this for a couple of years now, how much gold stocks were lagging the price of gold. And it's not really that obvious until you get to an index like this. Now, if we go back to 2011, which is the last peak in gold, it was at 1,920 US dollars, so up here. And at that point in time, GDXJ was trading at $167. Now we're trading at $61, and we're still just trying to break out of a base that has been running now for 12 years. Now, I know that the composition of the index has probably shifted. I know that costs of mining have gone up significantly, and therefore the profit margins weren't the same as they were back in 2011. So I know a lot of things have changed. But doesn't it strike you as odd just how far below global gold stocks are in terms of their relativity to gold? Now, whether this will get back to normal within a reasonable time period, as of the next couple of years, or not, is the unknown. But it just shows you the potential for catch-up in gold stocks. So, very interesting chart, that one. Right, let's finish off on other commodities. Copper was a real roller coaster during the week. It was amazing. $4.54. Nickel in the sixes. And really, when you look at whether it's copper or oil or whatever it might be, it was an absolute nonsense week of volatility, which really didn't reflect the underlying fundamentals at all. And you'll see that when we get to the copper chart. So crude oil also finished well down, 61.5. That certainly is helping inflation, but there's a lot of other things that are promoting inflation. The CPI in the US was down thanks to petrol prices, but I think we're yet to see the inflationary impacts. So there's the copper price, got down to almost $4 from $5.20. So an absolutely meteoric plunge, and then a recovery at the end of the week. And crude oil, well, it fell, but it really failed to bounce. So there's some real fears about global growth. All right, wrapping it all up. It's been a long session. This might be coming through a little bit out of order, which is extremely annoying. There we go. Most investors have got to think about changing their approach, and quite a bit, to get better outcomes. If you don't need better outcomes, fine. Keep doing what you're doing. But if you want a better outcome, then the vast majority of investors have got to start changing the way that they operate. And you can do that with employing the sharp perspectives that history tells us, gives us. Go back 10, 15, 20 years, as I've been doing in recent weeks, and look at the varying markets and see what we can learn from that sort of examination. Periods like we're in at the moment prove to be wonderful buying opportunities. However, you've got to be highly targeted, because there are going to be many stocks that will not recover because the environment will just change so much that their business won't be able to cope. And there'll be many stocks that will take quite some time. So you need to be very targeted. You need to gain conviction through whatever mechanism you need to get that conviction, because you need to stay the journey. You need to resist what the media is telling you, what the voices in your head are telling you. And I just pose a question. And this isn't being critical, this is just trying to get viewers to think about what they've done in the past. How many resolutions, whether it be New Year's Eve resolutions or whether it be stock market resolutions, how many resolutions get abandoned, and why do they get abandoned? And I would suggest to you the primary reason is you're not in an environment that allows you to see things with clear perspective. So highly successful investing is really very simple. And this is what I cover in Portfolio Analyst and the Insiders Club on a daily basis. Highly successful investing is very simple, but it's also very tough. It's very tough because of what challenges us in our mind and in our thinking, and how we get deviated from the track that we should be on. So really important. Portfolio analyst this week, no surprises, same as last week, preparing for the lows in the market whenever that occurs. And I don't have a high degree of confidence that we've seen the lows, but I'm more positive than I was last week. And of course, all the opportunities that go with that. So look, another longish video. Last week was pretty extreme, but I know from the correspondence that I'm getting that this is the sort of detail and depth that the viewers of this video want to see. So thank you for the feedback. There's more information on our website, and there's my email address, and I'll be back with you next Sunday, which will be Easter Sunday. Cheers.